And I'll give you the most famous example of the best company in India, I can argue, is Infosys. It made a dramatic top in March of 2000. It was a $46 billion market cap back then. It basically doubled in 24 years, which is, I mean, nothing wrong, but 20-year double is, I mean, drastic underperformance for a fantastic company. Company did everything right.
From the top of 2000 over the next 20 years,
46 billion to it's probably what, 93, 94 billion today. The market is up from 6,000 to close to 90,000 or 84,000, let's just say. So it's what, 14 times up. The market is 14 times up. Forget what's happened to other companies. Whereas the best company probably only doubled. And of course, I'm excluding dividends and buyback, but add a few percentage points there. But it's not that dramatic. So when you get pricing wrong in a small cap, heaven help you. And why small cap? Even from the top of 2007, when Reliance kind of went to sleep then for the next 12, 13 years, you didn't make any return. Then it quadrupled.
Here we have the market cap of Infosys Limited. If you look at the top of the market cap at March 2000, it was about $20 billion. He said $46 billion, so I'm not sure what he's talking about. It didn't reach $46 billion till about this Feb of in 2010, 2011, and then was about that point till 2019. So if you look at the overall graph, it reached a top of $20 billion. It was valued at $20 billion at the March of 2000, and then in the dot-com crash, it fell to $3 billion. So if you bought at the bottom or near bottom, let's say at around $4 or $5 billion, then in few years you would have made, it went up till $27 billion. So you would have made 6 times your money in a small amount of time. But if you buy at a higher valuation, then again see from 2011, if you bought at $43 billion, it stayed around that mark till 2019. And then again in COVID, it fell to $28 billion. And since then, in the current market boom, it has gone up 4 times in short amount of time in 2022. Then it came down to $60 billion, which was roughly half of this amount. And now it is back again to $81 billion. Now let's check the PE here for last 12 months data. So when the market cap reached $20 billion in March of 2000, the PE at its peak was 486. That's a dramatically high PE. Even at the other days closer to that, it was still around 400 PE. If you buy at such a dramatically high PE of 300, 400, even for good small companies, see ultimately what happens. The market cap goes down to $3 billion from a high of $20 billion. That is roughly just 15%. So it saw a dramatic 85% fall, and the PE fell from 400 to 30. Now, if you have a good small cap growth company, then 30 is a good PE to buy if it has growth, genuine growth. But if you buy at PE of 300, 400, then this is what the history suggests us, that not only the market cap fell drastically when the market crashed, but then from the low value, it again gave very good returns when the market bounced back. However, if you buy again at the top, then it consolidated at the same market cap for about, again, for a long time. And if you check the market cap for last 20 years only, and you see the P here, so it's been hovering from around high of 30s to 13. So every time if you buy at low PE ratio, see it is 13. From this point, it has only gone up and the PE goes up. But the moment PE goes up to 30, if you buy again, in future, the market cap has come down, the share price has come down, and PE has come down. Once again, if you buy at low PE of 12, 13, it consolidated for a while. Say, had you continued buy from 2012 till 2020, then in 2 years after 2020, you would have made a lot of money.